this game. But the good news is you have a whole bunch of time left in yours. And hopefully you're already feeling some freedom by implementing the halftime adjustments we discussed last week. Positioning you to improve your cash flow during these tough times was the main objective of this video series. That was the revising the playbook piece of it. But if you didn't come into this with a playbook already created, if that's what you're looking to achieve, the gathering and the valuation process that you went through in videos 1 through 3 has set you up perfectly to create your playbook. And today, we're going to finalize that with a series of best practices. So, what is the best universal play to call to give you the best opportunity to win your game? I'm glad you asked. There's 5, actually. 5 fundamental plays that you want to have in your financial playbook to set you up for success against even the toughest of opponents and the toughest of circumstances. So I'm going to roll them out and then we're going to talk about them in detail. 3 to 6 months in a dedicated emergency fund. 10 to 15% going to your 401k plan. Assessing and evaluating your income and your spending on a regular basis. Embracing insurance and thinking long-term when it comes to all things financial. These are the things that are going to make a meaningful difference in your financial life. These are the things that good playbooks are made of. So what does it mean to have a dedicated emergency fund? This means that you put money aside into a separate account and you dedicate it to emergencies only. This is when your air conditioner stops working in July. This is where you have to pay an unforeseen medical bill because your child broke their pinky finger. This is when you have to repair the muffler on your car. You see where I'm going. Emergencies, things that your cash flow is not designed to take on. You want 3 to 6 months because that is a number that will allow you to get through tough times, right? We've been in quarantine. Some people have been laid off or furloughed for going on 8 weeks now. So if you have 3 to 6 months worth of dedicated emergency savings, now would be considered a time where you tap into that and you're good to go. You've had your 8 weeks worth of emergency savings go to work for you in the last 8 weeks. You have 1 to 4 months additional that you can utilize if you don't find a job within the next 4 months, right? It also has to do with disability. So a lot of times when folks have to go on disability income insurance, they don't qualify until 3 to 6 months after they have the disability. So you need money to replace your income during that waiting period. So 3 to 6 months is the magic number. 3 is minimum. 6 is when you can say, okay, I'm done contributing to my emergency fund because it's fully funded. That being said, as soon as you take away from that account to pay for the air conditioner or the muffler or the medical bill, then you have to put together a plan to replenish it. You always want to have 3 to 6 months worth of expenses in an account dedicated to emergencies. That is an excellent way to keep your score high in your assets and hopefully the liabilities at bay. A question I get all the time is, how much should I contribute to my 401k plan? And the general recommendation is 10 to 15% of your income. Now, that doesn't take into consideration how old you were when you started contributing to your retirement. It doesn't take into consideration how much you currently make. It doesn't take into consideration how old you want to be when you retire or what kind of lifestyle or income needs you're going to have in retirement. So if you want a more accurate answer, I guess, you're going to want to take all of those things into account and you're going to want to do a calculation that allows you to see basically down to the dollar how much you're going to want to contribute to your retirement per month in order to achieve your goals. But for generalization purposes, 10 to 15% is a good goal. Minimally, you want to take advantage of your employer's match, right? So commonly, employers will offer half up to 6% in a match, okay? So that means that you contribute 6% to your 401k plan and your employer comes in and gives you an additional 3%. So instead of 6% of your income going in every year, you have 9% of your income going in every year. It's a gift, you guys. It's free money. Not to take advantage of an employer's match, 100% is literally giving up free money, okay? It is not a good idea. Figure out how to get to the maximum needed in order to get the match and make it happen. Something else to consider is your contributions to your 401k plan is tax deferred in most cases if you do pre-tax contributions. So if you contribute a little bit more, it's not going to feel like it because it's before tax, right? So it's not going to feel like $100 is going into is coming out of your paycheck. It's going to feel like maybe $70 or $75 is coming out of your paycheck because your paycheck is taxed. Your 401k contributions, the pre-tax kind, are not taxed, okay? So that's one thing to consider. Another thing to consider is when you get a raise, maybe just put the entire raise in your 401k. Then you have the same cash flow you did before you got the raise, and you're putting your money to work for you. You're making sure that your future self, your retired self, has more opportunity. So play call number 3, assess your income and spending. I'm not going to talk too much about the spending players and the spending side of the ball because video 3 was all about that concept. But you also want to assess your income players. You want to take a look at your W-4. What kind of allowances do you take? Do you claim 0 and get a big tax return at the end of the year? Or do you claim 3 and get a small tax return, or maybe even owe a little bit, but make sure that you have that additional cash flow every month to be able to contribute to your 401k, pay your mortgage, have the discretionary spending level that you like to have? What do your allowances look like? I also want you to look at your deductions. I have a client who had an FSA, a flex spending account deduction, for an entire year and a half after they were paying their daycare bill. They literally just took money out of their paycheck and threw it away because in a flex spending account, if you don't use it by the end of the year, you lose it. And they didn't even have the daycare bill that was required in order to utilize it for that purpose. So pay attention to your deductions, pay attention to your allowances, and make sure that your income players are doing for you what you want them to do to win the game. So this play is probably the most uncomfortable play in our playbook. Embracing insurance. I watch people twitch, break out in hives, almost cry, get angry, talking about insurance. And I get it, right? It's not a fun topic because you're talking about the potential for loss, right? You're talking about the potential for the loss of a spouse, for the loss of an income with disability, the loss of independence with long-term care, the loss of good health with health insurance, right? It's not a fun conversation, but it is critical. And I pursue these conversations with my clients all the time, and I trudge through the discomfort because I wouldn't be doing my job if I didn't. I wouldn't be helping you to protect yourself and give yourself the opportunity to have financial security when crazy things happen, when unforeseen situations occur. Similarly to this situation we're in right now. Nobody saw coronavirus coming. Nobody saw the deterioration of the economy or the loss of jobs across the entire world, right? So insurance for that is your emergency fund, right? Unemployment is a state-sponsored insurance, and thank God for that, right? But when it comes to insurance, that is your protection and that is your security. And as much as it's uncomfortable to talk about and it's not a fun experience actually getting insurance, it might be one of the most annoying processes ever, but trust me when I tell you, it's worth it. Having that peace of mind and security is worth it when you're alive and well, and when you're not, or you're dealing with a loss of some sort in life, then you have the opportunity to grieve appropriately instead of trying to make all these crazy financial decisions with your new financial situation that doesn't include insurance money that will help you fill in the gaps between your old life and your new life, now dealing with the loss of someone or some aspect of your life. Embrace insurance, you guys. Yes, you could go through your entire life and never use it. That is possible. You could essentially waste all the money that you put into your insurance premiums. But what if you need it? What if you lose your ability to provide future income to your family? What if you lose your independence in your old age? Do you want to burden your family members? Do you want to burden your kids or your parents? No. You want to be insured. Embrace insurance, folks. I cannot stress it enough. Okay, moving on to some lighter content. So our fifth and final fundamental play is to think long-term. Now, this is good advice for life in general, but when it comes to finances, thinking long-term is what separates the professionals from the amateurs. Long-term thinking allows you to say, I'm going to do these things today to better prepare me for purchasing these things tomorrow, okay? It gives you way more control. It makes it so that you don't have to qualify things as emergencies that aren't technically emergencies. If you have 200,000 miles on your car, you should be thinking about the fact that you're going to need to buy a new car, probably within the next couple years. You probably should be putting a little bit of money per paycheck into an account to create a down payment, or maybe even fully fund a new car in the next couple years. Those types of actions, that type of preparation makes it so that this emergency fund does not get tapped into unnecessarily, okay? Thinking long-term is something that people who have responsible financial habits exercise on a regular basis. What's on my horizon? What do I need in 6 months? What do I need in a year, 2 years, 5 years, 10 years, 25 years? What are the things that I need to be acting on today to make sure I am successful in the future? That's a wrap, team. If you take these 5 plays and make them the first 5 plays in your financial playbook, the need to pivot or call an audible on the field or implement halftime adjustments reduces significantly. These 5 plays allow you to go up against the toughest opponents and win. And that is what creating and revising your financial playbook is all about. How to better position you for the win. I just want to take a moment and thank everyone for joining me on this journey, this video series journey. Again, I'm Stephanie Anderson, Certified Wealth Strategist with Pulse Financial Services and your financial coach. And if you don't want your coaching to end, you can reach out. info@pulsefinancialservices.net is where you can find us. We work with folks across the country, and we are happy to be involved in your financial journey. Please let us know if we can be of further assistance. And before we call it, let's go ahead and gather up here. We're going to go win on 3. Ready? 1, 2, 3, win!